Hey guys, it's Nick. We got the end of the year coming up really soon, and people are starting to try to plan for how they can minimize their taxes. In this video, I'm going to show you using really simple graphical examples how to minimize your taxes on investments. Also, I will tell you why you should not keep losing stocks going into the new year. And finally, I will show you how to split different asset classes like stocks, bonds, interest, REITs, and collectibles like gold and silver between taxable and tax deferred accounts to pay the minimum in taxes. So let's get started. So before we start, let's look at the difference between short-term and long-term capital gains. A short-term investment is anything that's less than 1 year, and so long-term capital gains are only on investments that you held for over a year. But there's a big difference on the tax rate between the two. So for long-term capital gains, the tax rates are as follows. For a single person up to $40,000, it's a 0% tax rate. That's if you don't have any other earned income. But I'm going to use this 15% tax rate because most people fall between the $40,000 and $445,000. And if you make over that, the tax rate is 20%. That's for long-term capital gains in 2021. Now let's look at the short-term capital gains tax rates. So it's about 10% up to $10,000 in income for a single person and goes all the way up to 37% if you make over $523,000. In this example, I'm going to use 32% as the short-term capital gains tax rate for an income between $164,000 and $209,000. So let's look at the different amounts you can pay in taxes depending on how you play these gains and losses. So these are over 1 year, so meaning long-term capital gains and losses, and these are under 1 year, meaning short-term capital gains and losses. So let's assume this is one stock each, right? This stock, you're up 10,000 and you held it over a year. This one, you're down 5,000, you held it over a year. This one, you're up 10,000, you held for less than a year. And this one, you're down 5,000, you held for less than a year. Now, if you were to just sell this stock here, your tax rate would be 15%. But if you were to sell this stock here, your tax rate using the 32% tax bracket would be 32%. So let's see how we can best maximize the gains and minimize the taxes. So according to the IRS, you're supposed to net out your long-term capital gains that you realize with your long-term capital losses that you realize. So if you were to sell this and this, you're supposed to take this $10,000 and wipe out this $5,000. So you'll have $5,000 left in gain at a 15% tax rate, and your tax on these two together, if you were to sell them both, would be $750. Now for this, you would take this $10,000 if you sold the stock and you sold this stock, and you would net them together, and you would also have $5,000, but at a 32% tax rate, and so that tax would be $1,600. So together, you would pay $1,600 plus $750 or $2,350 if you sold all of these together. But you can handle this a lot smarter and pay less taxes. So the name of the game is reducing this number to as low as possible because you're paying the most tax on any gain, right? So what you would do is, of course, you would realize this gain because you want to sell your losers because that's always a good idea. But you would also realize this loss too. And so you would sell this stock. And so now you have two $5,000 losses that completely wipes out this $10,000. So the net gain here in your short-term stuff is zero. So zero taxes there. And you would hold this past the new year. So one day after the end of the year, you can sell this and realize that $10,000 long-term capital gain. And your tax on that would be $10,000 times 15% or $1,500, which is about $850 cheaper than just selling everything and netting it out like I just showed you. So really the best strategy is to try to knock down your short-term gains as much as possible by throwing any kind of open losses that you have at it. So any stocks that are showing a loss before the end of the new year, sell them and reduce any of your short-term gains by that amount as much as you can, because that lowers your tax bill by the most amount, since this is taxed at the highest rate. So that's it in a nutshell. Sell whatever losses you have to the point where you can completely knock out your short-term gains, or as much as possible. Now, if you realize more losses than actual gains during the year, you can only write off $3,000 in losses per year, but the rest of that amount carries forward. So let's say you lost $30,000 this year after netting out all your gains. You can deduct $3,000 this year, $3,000 next year, $3,000 the next year for the next 9 years until it's all paid off. I would generally try to avoid that $3,000 carryover capital loss. It's a bit of a hassle and it's not much money. And this $3,000 number is unchanged since 1978. So it's becoming more and more meaningless as we go on with inflation. And just to show you what that $3,000 should really be today in 2021, if you take 1978 and put in $3,000 in this inflation calculator up to 2021, the new number really should be $12,726. Now, about holding losing stocks. It's human nature to hold on to losing stocks even as the loss gets bigger, while selling winning stocks even with small gains. This is an ego thing. We don't want to sell the losing stocks because that is admitting to ourselves that we are wrong, or worse, that we are stupid. So because of this, we stubbornly hold on to losing stocks way longer than we should. I'm sure if you look at your biggest losses, you will see they started out small and maybe they got even bigger as you averaged down because you didn't want to admit that you were wrong. Now, most people's biggest losses are larger than their biggest gains. And so this is why you should not average down, and this is why you should not hold on to losing stocks into the new year. The best thing you can do is sell the losing stocks and offset them with winning stocks. This gets you into the habit of not holding on to losers, and it lowers your tax bill by reducing your realized gains. Now, to optimize your investments even more, let's look at which type of investments should go into a regular taxable brokerage account and which ones should go into tax-deferred accounts like 401ks, IRAs, Roth IRAs, and SEP IRAs. Okay, so now let's look at where to best put different assets between taxable and tax-deferred or non-taxable accounts. Tax deferred would be a 401k at your job, an individual IRA or a SEP IRA, and a Roth IRA is not tax deferred. It is zero tax, but it's in the same category here. So which one of these should you put where? So first of all, stock. That depends. If you are planning on doing a lot of short-term trading or have a lot of short-term gains, you are better off putting that in the tax deferred category because it's going to get taxed at a much higher rate, 32% or whatever, more than that. So you would rather keep it here because you're not going to pay those taxes every year until you start pulling it out when you'll be in a lower tax bracket, most likely. But if you want to have stock that you hold for, say, dividends or really long-term gains, you would put that in the taxable account. And that way you would keep your gains to only capital gains, long-term capital gains, and qualified dividends. And so you would pay that 15% tax rate in the taxable account and 0 over here on the short-term gains. Now, the interest that you get from bonds and bond funds or bond ETFs gets taxed at your regular income rate. So you want to put those investments, if you have any, in the tax deferred accounts. Same thing goes with interest that you get from a bank CD or a money market account, something like that. It gets taxed at the regular income rate, so you want to keep those in the tax deferred accounts. And as for REITs, real estate investment trusts, which are like an ETF for real estate, basically, the distributions that they give you are not dividends. They're called distributions, and those are taxed at the regular income rate. So you definitely want to put those in the tax deferred as well. And one last thing, collectibles, which could be art or whatever, but for most people, it is precious metals, gold and silver, that kind of thing, whether it's coins or bars, silver or gold or platinum or whatever. Those are considered collectibles. And even if you own them through like the GLD ETF or the SLV ETF, those are still considered collectibles, and they get taxed at a rate of 28% no matter what your income is. So you most definitely, if you're going to buy GLD or SLV or something like that, do that in your tax deferred account. So really, the only thing you want to have in your taxable account is stocks that you plan on holding for the long term and stocks that you plan on holding long term for the dividends that they give you. So I hope this video clarified the strategies you should use to minimize your tax bill in the future. If you like this video, hit the thumbs up, and I'll see you in the next one. Thanks for watching, guys.